Right now, as you watch this, a clock is ticking inside a vault system in Lower Manhattan. In exactly 16 days, on February 27th, the largest precious metals exchange on Earth faces a delivery deadline it may not survive. The numbers are simple. The March 2026 silver contract carries open interest, representing 429 million ounces of metal. The exchange is registered inventory. The silver actually available for delivery sits at roughly 103 million ounces. And that number is falling by nearly 800,000 ounces every single day. This is not a forecast. This is not speculation. These are figures published by the CME Group itself, updated daily, visible to anyone who cares to look. And yet the financial press is barely whispering about it, because acknowledging what these numbers mean would force a conversation that Wall Street, the regulators, and the bullion banks have spent decades avoiding. The conversation about what happens when paper promises collide with physical reality. Today, February 11th, silver surged 6% to $85 an ounce. That move looks dramatic on a chart. But zoom out, and it tells a stranger story. 2 weeks ago, silver was trading above $121, an all-time record. Then it crashed 33% in a single day, the worst session since 1980. Treasury Secretary Scott Bessent went on Fox News and blamed it on Chinese traders running what he called a classical speculative blow-off. The official narrative is tidy. Reckless speculators got wiped out, order has been restored, nothing to see here. But the vault data tells a different story entirely. During that crash, during the very sessions that were supposed to flush out the excess and calm the market, physical silver continued leaving COMEX warehouses at an accelerating rate. In the first 2 weeks of January alone, 33 million ounces walked out the door. That is 26% of the registered stockpile vanishing in 7 days. The crash did not solve the supply problem. The evidence suggests it made it worse because it gave well-capitalized players a chance to buy physical metal at a steep discount while the leveraged speculators were being liquidated. 16 days from now, we find out whether the world's benchmark silver exchange can actually deliver what it has promised. And the math, as of tonight, says it cannot. To understand how the system reached this breaking point, you need to see how the architecture was built, and where the cracks started forming long before anyone was paying attention. The COMEX silver market operates on an assumption so fundamental that nobody questions it. The vast majority of futures contracts will never demand physical delivery. Traders buy and sell paper claims on metal they never intend to touch. They roll positions forward, take profits in cash, or offset contracts before expiration. For decades, this worked. The actual delivery rate on COMEX silver hovered in the single digits, 5%, sometimes less. The exchange needed only a thin cushion of real metal to keep the game running smoothly. Think of it like a bank. A bank does not keep every depositor's cash in the vault. It keeps a fraction, lends out the rest, and trusts that everyone will not show up on the same day demanding their money. This is called fractional reserve banking, and it works, until it doesn't. The silver futures market operates on the same principle. The ratio of paper silver traded on COMEX to the physical metal available for delivery has, at various points, exceeded 300 to 1. 300 ounces promised on paper for every 1 ounce sitting in a vault. What changed in 2025 was the delivery behavior. Total COMEX silver deliveries doubled in a single year, from 203 million ounces in 2024 to 474 million in 2025. Every single month ran higher than the same month the prior year. This was not noise. This was a structural shift. Players who had been content to hold paper claims began insisting on physical metal. By December 2025, 46 million ounces were delivered in 1 month. Roughly 50% of the estimated free float registered inventory gone in 30 days. Then came January 2026. In what is historically a minor delivery month, COMEX processed 49.4 million ounces, 7 times the January 2024 level. The market was front-running March. Participants were pulling metal before the big delivery month arrived, securing physical silver, while the vaults still had it to give. If this kind of analysis is what keeps you ahead of the curve, hit subscribe now. Because what I am about to show you about February's data turns this from concerning into unprecedented. The February numbers landed like a quiet earthquake. As of early this month, 18.7 million ounces have been called for delivery against open interest of 19.1 million. That is a 98% delivery rate. In a functioning futures market where most contracts roll forward or settle in cash, a 98% physical delivery rate is not normal. It is a signal that market participants have stopped treating COMEX as a trading platform and started treating it as a physical allocation mechanism. The conveyor belt that carried paper promises for decades is now being asked to produce the actual metal. And March, the largest delivery month of the year, is 16 days away. Here is where the official narrative and the warehouse data diverge into 2 completely separate realities. The story you're being told is that silver's crash from $121 to $75 in late January was a healthy correction, leveraged traders getting punished for excess, the system self-correcting. Treasury Secretary Besant specifically called out Chinese traders, pointing to the UBS SDIC Silver Futures Fund in China, which had been trading at a 36% premium to its net asset value before Chinese authorities raised margin requirements and triggered a cascade of forced selling. That part is true. Chinese leverage was extreme and the unwind was violent. But Besant's explanation is a spotlight on one corner of a much larger room. What the spotlight deliberately misses is this. Since 2020, COMEX registered silver inventory has fallen approximately 75%. The current level of around 103 million ounces is not a temporary dip caused by speculative frenzy. It is the endpoint of a 5-year structural decline driven by forces that have nothing to do with Chinese day traders. Industrial demand is the engine. Every solar panel manufactured on this planet requires roughly 0.64 ounces of silver. Hundreds of millions of panels are installed annually, and that number is growing. The semiconductor industry, supercharged by the artificial intelligence build-out, is projected to consume 23 million ounces per year by 2030. Electric vehicles use twice the silver of conventional cars, about 1.3 ounces each, and global EV sales jumped 20% last year alone. Silver has entered a 5th consecutive year of supply deficit, with the 2026 shortfall projected near 200 million ounces. Unlike gold, which is primarily held and recycled, silver gets consumed. It goes into circuit boards, solar cells, medical devices, and battery contacts. It does not come back. Now, layer the geopolitics. In January, the U.S. Department of the Interior officially designated silver as a critical mineral. That is not a symbolic gesture. It unlocks federal funding, stockpiling authority, and supply chain prioritization. Simultaneously, China has been tightening export controls on refined metals, restricting the flow of processed silver to Western markets. 2 superpowers are now competing for a metal whose above-ground deliverable supply is shrinking by the month. And into this environment walks the March 2026 COMEX contract, carrying open interest that represents over 400 million ounces of theoretical delivery obligations against a registered stockpile that, at current drainage rates, may fall below 85 million ounces by first notice day. Even if only 25% of contracts stand for delivery, a conservative assumption given what January and February have shown, the exchange would need 107 million ounces it likely will not have. So here is the picture when you pull every thread together. The January crash did not reset the silver market. It accelerated the very dynamic it was supposed to relieve. During the sell-off, institutional players, the ones with deep pockets and physical storage infrastructure, were buying the dip in real metal while leveraged retail was being forced out of paper positions. The crash was a transfer mechanism. Weak paper hands were flushed, strong hands took delivery, and the vaults kept draining. Today's 6% surge to $85 is not a random bounce. It reflects a market beginning to price in what the vault data has been screaming for weeks. There's not enough registered silver to satisfy March delivery at anything close to current participation rates. Bank of America's metals research team, led by Michael Widmer, has published a forecast range for silver in 2026 of $135 to $309 per ounce. The upper target is based on the gold to silver ratio compressing to levels last seen during the Hunt Brothers episode of 1980. Even the conservative end of that range represents a 60% gain from here. JP Morgan, more cautious, forecasts $85 by year end, the price silver is trading at right now in February. UBS expects silver to retest $100 within a month before settling back. But these forecasts assume an orderly market. If March delivery produces a genuine shortfall, if COMEX cannot fulfill physical obligations and is forced into cash settlements or emergency protocols, the pricing models break. Historical precedent from the 2022 London Metal Exchange nickel crisis, where the LME canceled billions in trades and suspended the market for a week, shows what happens when an exchange cannot honor its contracts. Price discovery collapses, trust evaporates, and the premium for physical metal over paper claims explodes. There's a question buried in all of this that no analyst on financial television is asking publicly. If COMEX registered silver falls below the threshold needed for March delivery, who absorbs the loss, and what does that mean for the credibility of the entire futures pricing system? That is the question worth sitting with. Drop your analysis in the comments. Some of the sharpest thinking on this channel comes from this community, and I read every response. The implications do not stay inside the metals market. Silver is embedded in the supply chains of solar energy, semiconductor fabrication, electric vehicles, and medical technology. A delivery failure on COMEX would send shockwaves through industrial procurement, forcing manufacturers like Samsung, which has already started locking up mine output through direct prepayment deals, to bypass exchanges entirely and secure metal through bilateral contracts at whatever price the market demands. 16 days is not a long time. In financial markets, it is an eternity and a heartbeat simultaneously. Between now and February 27th, several things will become clearer. The daily warehouse reports will show whether silver continues leaving COMEX vaults at the current pace. The open interest in the March contract will reveal how many participants are standing firm versus rolling to later months. And the spread between spot silver and futures prices, the basis, will signal whether the market is pricing in delivery stress or calm resolution. What we know today is this: the 5-year trend of rising physical delivery demand has not reversed. The registered inventory decline that began in 2020 has not reversed. The industrial consumption growth driven by solar, semiconductors, and electrification has not reversed. The geopolitical competition between the United States and China for critical mineral supply has not reversed. Not one of the structural forces compressing supply against demand has changed direction. The January crash addressed the symptom: excessive speculative leverage, while leaving every underlying cause fully intact. There are 2 paths forward from here. In one scenario, enough March contract holders roll their positions forward. The delivery crunch is deferred to May or July, and the system buys time. The price stabilizes in the $80 to $100 range, while the structural deficit continues to erode inventory more slowly. This is the orderly outcome. It is possible. It is what the exchange operators and the regulators are working toward. In the other scenario, the participation rate in March delivery matches or exceeds January and February patterns. The exchange faces a shortfall. Emergency measures, expanded margin requirements, position limits, forced cash settlement are deployed. The paper price of silver decouples from the physical price. A 2-tier market emerges. One price on COMEX screens, a different and much higher price for anyone trying to acquire actual metal. This has happened before in other commodities. It happened with nickel on the LME in 2022. It happened with palladium during the Russian sanctions. And the conditions for it to happen with silver are more advanced right now than at any point in modern market history. At the opening of this video, I told you a clock is ticking inside a vault system in Lower Manhattan. That clock does not care about analyst forecasts, Treasury Secretary press conferences, or what any government calls a speculative blow-off. It runs on a single input: how much metal is in the vault versus how much has been promised. As of tonight, the promises exceed the metal, and in 16 days, that gap either closes or it breaks open. The vaults do not lie. The question is whether anyone is listening before the deadline arrives.